The word of the day is correction. Investor Beat starts now. Thanks for watching. I'm Alison Southwick. The Nasdaq continues on its downward turn again today, falling below 4,000 points. 29 of the Nasdaq 100 stocks are cozying up to bear territory. Joining me in studio now is Mike Olsen and Morgan Housel. Like I said, correction is the word of the day. The Nasdaq has been going deeper into the red, pulled down by social media and biotech stocks, companies like Google, Amazon, Gilead. Analysts are generally saying this is a correction, though, not a crash. So, Morgan, take me back to school here. And when is a correction a correction?
Well, it's typically 10 to 20%. I think most people, it's technically 20%, but most people will start responding to it by panicking and freaking out well before that. So, of course, on the S&P 500, we're nowhere near that level. On the Nasdaq, a lot of individual stocks are already well past that. But these corrections, these 10 to 20% pullbacks, these are the things that investors should expect to happen once a year in the 10% range, roughly, and 2 or 3 times a decade in the 20% range. That's what we've seen historically. The distribution of that will be different going forward. But these things are normal, shouldn't really freak investors out. This is part of the game of investing. Right.
So, Olsen, you strike me as a value sort of guy here. Do you feel that this so-called correction is really due?
I can't really speak to the valuations of the companies themselves and whether or not this will prove prescient or absolutely stupid 10 to 20 years from now. I think more broadly speaking, the mere fact that the market is willing to revalue these companies to the tune of 20% within a given week speaks to its fickle-mindedness, and perhaps that there was a little bit too much optimism. You have to ask yourself the question, how can a given company's value change 20% within a given week? You want to talk about some of these companies more specifically. Tesla, for example, which has been one of the recipients of this corrective measure, you basically have to believe that they'll claim 1% of the global auto market, be able to sell each auto at $55K a tag, have industry best margins, and that is what you need in order to justify today's stock price. If you think there's any upside from here, you have to believe that they're either going to be able to go ahead and sell space on their network of chargers, the gigafactory and electric batteries have legs, or something that we haven't already contemplated. Amazon's one that's perhaps more interesting right now on account of the controversy surrounding how much money it can make and how large it gets.
All right, so Morgan, bottom line, what's your advice to investors?
I think all investors should be in the market for at least five years, hopefully more than that, 10, 20, 30 years. And during that course, as an investor, you're going to see a lot of these things happen. So they shouldn't surprise you. They shouldn't worry you. This is the cost of investing. If you don't want volatility, there are plenty of good CDs and money market funds out there for you. If you want the superior returns that stocks generate over time, this is the price you pay. And if you're not willing to pay it, it's going to be a tough road for you.
All right, well, let's move ahead and look at some of the day's movers and shakers. Google has acquired Titan Aerospace, a maker of solar-powered drones. Google says they could use the technology to collect high-resolution images and offer internet access in remote areas. So, Mike, in the drone wars, we have Facebook, Amazon, they're working on technology. So, of these companies, which technology do you think is going to dominate and destroy all humankind in the future?
Right,
and is that an investing thesis worth following?
I don't pretend to know whether or not this is an investing thesis that is worth following. I think that for Google, this is a deal which presents interesting optionality. It allows them a chip in. It gives them a little bit of bargaining power as if and when broadband is built out in these developing nations, because they also offer broadband. So instead of basically being beholden to them as they are in the States, they can bargain with them. There's another thing that's kind of interesting about this, and that is this in the context of maybe a Google Maps or something like that. They are able to go ahead and pinpoint their customers, specific locations, restaurants, so on and so forth, with greater degree of accuracy. That makes their ad algorithms a little bit more intelligent, and in turn allows them to make just a bit more money. As ads become more and more local, I think that's going to be something that's important. You also have to consider this is probably pretty cheap. Facebook paid $20 million for their drone provider, and so this isn't a big bet on Google's part.
Shares of Coca-Cola are up today after the company beat analyst expectations for first quarter earnings. Revenue was down 4% for the quarter, though, as the company faces dwindling consumer thirst for soft drinks. And I can't even say the word thirst, apparently. Morgan, what do you think Coca-Cola needs to do to combat this trend?
Well, I think it's less of what Coca-Cola needs to do and more of what Coca-Cola investors need to do, which is reset their expectations for what this company is. For years, if not decades, everyone said, Coca-Cola is the company that you can project sales out, easily 10, 20 years in the future because everyone's always going to be drinking soda, and they will. But this just goes to show that there's nothing guaranteed in business or investing, and something as stable and as solidified as Coca-Cola goes through trends where people want to drink more and less of it. So I think Coke investors should just look at it and say, this is not a sure thing. We shouldn't be pricing it as this is a guaranteed bond going forward, as I think a lot of investors probably did in previous years.
Right. I think an interesting amalgam for this is possibly the cigarette companies. I don't want to liken soft drinks to cigarettes because that is a politically charged thing. But cigarette companies face declining consumption on a continuous basis, but they were always able to make it up in price increases and growing consumption internationally. It's much the same for Coca-Cola on an international basis. Per capita consumption of Coke products, much less. And in the States, you might conceivably argue that any volume declines will be offset by pricing power because people still love the sugar water.
Well, there you go. Motorola has sold off its enterprise business, which produces rugged hardware like computers, tablets, and barcode scanners, often used by retailers to track inventory. The buyer is Zebra Technologies Corp, a barcode printer maker. Do you think this was a good deal for both companies?
So I think this is a pretty interesting deal for Zebra in particular, because what they had previously was they had the barcode printing technology. This is a very fragmented market where they own a dominant share, and they have significant advantages in distribution and R&D. Motorola Solutions business, they were sort of the organizational plumbing of this, and so they provide the software and hardware which allows companies to track movements of inventory, product, size, weight, so on and so forth, so they can adjust on the fly. The idea here is that you're going to create an integrated entity where you have sort of a soup to nuts offering, which in turn provides value for customers because they're able to deal with a single vendor and the technology, ostensibly speaking, works together. And for Zebra, it increases the switching cost to customers. Right now, it looks like this thing is probably priced at about 12 to 13 times pro forma cash flow. And looking at what could be a very high quality business, and this is a big bet, they're taking on a lot of debt. The integration is going to be very challenging because it doubles the size of the company. But if that works out, this could be a pretty interesting gambit.
Citigroup shares are up after beating, let's say, low analyst expectations for the first quarter. Profits were up 4% despite the really rough go the company has had lately with fraud and, of course, failing to pass the reserve's recent stress test. So, yeah, I'm still not buying Citigroup. I don't care if they beat analyst expectations.
But you know what's great about failing the stress test is that for years these stress tests have been a joke, and everyone knew they were a joke. They're always way too easy for the banks. The banks passed them with flying colors regardless of what was going on and could go back to business as normal. I think it's great that the Fed looked at Citigroup and said, no, we're not happy with this. We're going to fail you. And Citigroup needs to go back to the drawing board and shore up his books. That's great. That's the point of these stress tests, and I'm glad the Fed finally has a backbone. And it's good for long-term Citigroup shareholders, too, because now they're going back to the drawing board and shoring up their books, and they're going to come out of this as a stronger company for long-term shareholders.
All right, that's going to do it for today. What's one stock on your radar?
It might not surprise you, but Amazon is that stock. I think this is a very interesting company on account of it being such a behemoth and stalwart, and yet nobody really has a good idea of what its prospective size or earnings power is. On the matter of its prospective growth potential, I think that e-commerce is a winner-take-all game where those companies that create the deepest marketplaces have the most scale, benefit from sort of a virtuous cycle. Customers come back to their sites and they're able to offer lowest prices. On that basis, I don't think it's inconceivable to think that Amazon, which does $75 billion in sales, could at least double its sales over the next 10 years and possibly a lot more. On the matter of how much money it makes, you got to think about this in a practical context. Amazon had to meet its customers where they are from the very beginning. They couldn't take a modular approach to growing. So you want to put this in context. Walmart has 148 distribution centers and $475 billion in sales last year. Amazon, $75 billion in sales, 102 distribution centers. So if you're of the belief that they're going to continuously grow, there's a lot of potential for them to grow into that earnings power. It's something worth looking at on the pullback.
All right, how about you, Morgan?
The single most common question that we get these days is what is still cheap, because everyone thinks all the stocks are so expensive out there. Berkshire Hathaway, I think, is one of the stocks you can still look at and say, this is not only a phenomenal company, everyone knows that, but it's still pretty cheap. It's still trading about 1.3 times book value. So that's one of the few, that's one of the last remaining companies, good companies, still a good price.
All All right, well, for Mike Olsen and Morgan Housel, I'm Alison Southwick. Thanks for watching.